Mr. Parsons and Mr. Finnegan, I understand that Merrill, Lynch, and Citigroup have different policies on this issue. You've taken steps to prevent executives from selling shares without approval. You require your CEOs to obtain the approval of the General Counsel before altering their stock trading plans. Mr. Parsons, if the CEO of Citigroup proposed to sell $150 million worth of stock at the same time Citigroup was engaged in a massive stock buyback, would this raise any red flags for you?
Well, Mr. Chairman, as you pointed out, we have procedures in place that would first flag it, second cause counsel to opine on it, and perhaps more importantly to your question, I didn't address it in my opening remarks, it's in my statement, but Mr. Prince addressed it in his opening remarks. We have a stock ownership requirement that would probably preclude the CEO, such as Mr. Prince, from doing just what your question implied. Namely, all senior officers and all board members have to retain during their term of service at least 75% of all of the equity compensation that they've received over the course of the years they've worked for the company. So unless someone had literally billions, they wouldn't be in a position to move on that level of stock that you just indicated. But beyond that answer, what we would do, I'm sure, we would consult with counsel, we would consult to understand the reasons, and we'd make a judgment based on the facts that we found them then.
Mm-hmm. And you would do that to protect the shareholders, isn't that the whole idea of
and the process, and the process, if you will, because frequently appearance is equally important with substance and reality.
Thank you. Mr. Finnegan, you're a board member at Merrill Lynch. I want to ask you the same questions. Would this kind of a transaction raise a red flag for you?
Well, let me echo Mr. Parsons' remarks first. The fact is that we have stock retention requirements, so it would be purely hypothetical. Mr. O'Neill never had the kind of stock holdings that Mr. MOZILO had, such that he could have been selling $150 million worth of stock and complying with our stock retention requirements. Like at Citi, if Mr. O'Neill wanted to sell stock, he would have come to the Compensation Committee, and we would have talked to the General Counsel. It would have required approval. Again, the magnitude here, because of the difference in stock holdings, really, wouldn't have been relevant at the time. I also think that I have no reason to believe, nor do I have any reason to believe, that our board members would see anything consistent with selling stock when you were doing a stock buyback. Stock buybacks are put in place. They're generally considered very investor-friendly. Your investors like to see them. They improve earnings per share. They improve return on equity. We wouldn't necessarily make any decision on a proposed stock sale because we're in a stock buyback situation. Again, the issue would always be magnitude. Is it within the rules? And what would the perception be? And we would consult with General Counsel on the matter and then make a decision.
Well, here's the problem I have with the stock sales. Mr. MOZILO and Mr. Snyder seem to be saying two completely inconsistent things. You tell the shareholders that Countrywide stock was undervalued and a great investment for the company and its shareholders to make, the reason for them to buy the shares. But when you acted in your personal capacities, you were selling millions of shares, and that doesn't speak well of your faith in the company's stock. I'd like you to respond to that.
Mr. Chairman, I was with the company 40 years. I was going to retire. Almost all of my net worth was in Countrywide. I had to come to a point of diversifying my investments and my assets. And that point came in 2004, and I consistently followed that plan. It was my belief that every time I set the plan in place, one is not my belief, it's the fact that the shareholders knew exactly what I knew. I set them in place after earnings were announced, and any plans were announced. They were aware of the buyback. They were aware of earnings the previous quarter. And our projections for the ensuing years demonstrated that we were going to increase capital, and because the company was doing extremely well throughout that whole period of time.
Well, I think the reason that Mr. Parsons indicated it might not look good is the whole example of what happened with Enron. Because with Enron, they were selling the stock, the executives were selling the stock, and they often have knowledge that no one else would have, and I think all of this is still being investigated. But the appearance is not a good appearance if you're telling your shareholders it's a good investment to buy the stock for the corporation, at the same time you're selling the stock to benefit yourself at that higher price.
Well, I think, again, the investors, who are mostly institutions, made the decision whether to buy or sell the stock based upon the information we provided. I never asked anybody to buy the stock, nor to ask anybody to sell the stock. We presented our performance. We had a 30-year performance of no losses.
Well, my time here has expired, but I must say your timing was awfully good for yourself, but not particularly for some of the other shareholders.